Mark Zandi, I'm going to start with you because you said today, I believe, that you still expect 4 rate hikes in 2019. You didn't hear that?
Yeah.
Anything that changes that point of view?
No. I think Steve got it spot on. He said, and if you read the text of the speech, which he actually the way he said it was a little different than the text. In the text, he said just below the broad range of estimates of the neutral rate. Steve is right. That broad range is 2.5 to 3.5. The midpoint of that is 3. We're at 2.25. So I don't think he changed his mind at all. I just think he presented the language a little differently and probably did it the right way because he didn't want to spook investors because investors are already
well, he did the
spooked.
opposite of spooking them. I mean, he did the opposite of spooking them because they're hearing a much more, it seems to me, a much more gradualized approach, an approach that means that we're closer to what he thinks neutral is. I guess we are because we had a rate hike in in September. But anyway, Julia, let me turn to you. What do you think?
Okay, can I just say one thing?
Sure, please.
Just one thing about next year and the 4 rate hikes. Look, we're at a 3.7% unemployment rate. If we're growing at 3, and the Powell said we're growing at 3, and neutral is 2, a year from now, the unemployment rate is going to be near 3%. That's going to be very difficult to ignore and not raise hikes in a more aggressive way.
But he said, didn't he also say he liked where unemployment was? He liked inflation is roughly where their target is.
Yeah.
It
and
feels
we are
like
seeing some leading indicators of some moderation in growth. We're seeing interest rate sensitive sectors like housing, like CapEx starting to moderate a little bit, nothing worrisome. But I think what I'm hearing when he talks about getting close to the broad range, and then he also emphasized the lags in monetary policy. And that means, remember a couple of weeks ago, he talked about feeling your way through a dark room. I think what the Fed wants to socialize is we might take longer pauses in between rate hikes as we get into that range of neutral. And we are not going to do that to signal that we're worried about the outlook or that we're at the end of the rate hiking cycle, but just that we need to fine-tune the economy.
I think the tonic for the market was no preset policy.
I think it was a combination of both.
That was the
and that goes hand in hand with that longer pauses.
So how do we interpret the difference then between Jerome Powell's comments in the beginning of October, his comments now, which Steve is arguing may not have been that different, just the way that it was framed is different, right? Has there anything in the data perspective that has changed for Jerome Powell between then and now?
That's a great question. So first of all, that comment he made was off the cuff. It was in a conversation in response to a question. This was a prepared remark, so this is more intentional, right? But there have been a few things that have changed. As I noted, the interest-sensitive sectors have moderated. Housing has been weak, or at least
oil
plateaued.
prices are way down.
Inflation is
market volatility, the correction in equity markets, the tightening in financial conditions, widening credit spreads. These are an indication.
2 negative quarters in Europe.
Something I never thought I'd have to say. Kevin, jump in here.
I looked at it a different way. I like the no predetermined course because to me that is the old school way of saying data dependent.
Right.
I think Powell's playing a different card, actually. When I listen to that, I read that he's trying to gauge how to play the trade tariff risk. So with this new direction, which was well received, and I liked what he said, if it's a disaster in January, if we actually impose 25% tariffs across the entire economy, which Steve and I have been debating of late about the impact of that, it gives him plenty of time to stretch out the next rate hike, to wait to see what the impact would be. And I'd argue it's going to take a lot of quarters before that 25% actually hurts free cash flow, because so far the 10% tariffs are irrelevant in domestic earnings. They are irrelevant. Yes, I know there's a perceived risk and CEOs are job-owning it, but when I look at the numbers, completely absorbed, perhaps by tax hikes, perhaps by deregulation.
Or maybe a pull forward on inventories.
Could be. All of these things are. But right now, what I like about this Fed is, look, there's a huge cliff coming. I can't talk about it because I'll freak all of you out if I say this. But now I'm going to give myself lots of flexibility about when I do that, 2019 first rate hike. I think we're getting the one in December, Steve. I think we're getting it.
I agree with you, Kevin. I think he's playing for time a little bit here, and he needs to play for time because what Julia said is things have shifted a little bit. Housing is taking it real hard. And by the way, just the other side of that is we expect good jobs and good wages to bring back housing, or at least help it and buffer the Tyler, you wanted to jump in?
Mark, let me come back to you with further thoughts here. But if I'm hearing your interpretation correctly, that band of neutrality goes somewhere from 2.5 to 3.5%. So that means from here you could get five quarter-point hikes between now and the top end. So you think we're going to go to the top end?
Yeah, absolutely. I mean, if we're going to a 3% unemployment rate and labor markets are as tight as a drum now and wage growth is accelerating now, can you imagine what it's going to be 6, 12 months from now?